Welcome students, welcome to lecture number 28 where we will be continuing module number 4, income from capital gains under subject direct taxation. So today we will be seeing the continuation of computation of capital gains, okay, and deductions from capital gains. So today we will be covering computation of capital gains and deduction from capital gains. So we know capital gain is nothing but gain arising from transfer of capital asset. What is the meaning of transfer? What is the meaning of capital asset? We have already seen. Once we know that a particular asset is a capital asset and the transfer, then we have to make sure that it is taxable under the head capital gains. We know there are two types of capital gain, short-term capital gain and long-term capital gain. When is a particular gain categorized as a short-term capital gain is when the gain is arising from transfer of short-term capital asset. Similarly, if you are transferring a long-term capital asset and if you are gaining from that transfer, it is said to be a long-term capital gain. This is cost inflation index, which is needed in those situations where there is a long-term capital gain, because in case of long-term capital gain, there is indexation benefit given, and that is where we use this cost inflation index. Now, yesterday in our previous lecture, we had left a particular part under computation of capital gain, that is capital gain on transfer by the way of compulsory acquisition. You know that compulsory acquisition means where your property or where your capital asset is compulsorily acquired under any law. Under any law, if your capital asset has been acquired, it is regarded as a transfer and capital gain arises. So let us see, when any law, under any law, maybe the court is compulsory acquiring your property, capital asset, or maybe the government is compulsorily acquiring your capital asset. Then when they compulsory acquire, they give you some compensation in return, because they're taking your capital asset. In return, they will give you some compensation for acquiring your capital asset. So in that scenario, let us see what are the different terms and what is the amount we have to take for different terms. So first, when you're receiving the compensation, sales consideration will be nothing but compensation received or receivable. Suppose your house property has been acquired by the government, okay, for enlargement of the roads, then and the government has promised you to pay a compensation of suppose 50 lakhs. So 50 lakhs will become your sales consideration. Cost of acquisition, cost of improvement, it will be as usual, normally what we follow. Expenditure on transfer will be legal expenditures incurred to recover the claim shall be allowed as deduction. So whatever court case, like suppose if you have filed a court case against the government, or whatever legal expenditures you are incurring for such compulsory acquisition, that also will be an expenditure on transfer. Now, in which year it is taxable? In the year in which such compensation, consideration, or part thereof is first received. Suppose you have to receive a compensation of 50 lakhs. Out of 50 lakhs, 20 lakhs you have received in the year 1920. So out of 50 lakhs, 20 lakhs you have received in 1920. So the entire compensation will be taxable in the year 1920, because first compensation is received where? In the year 1920. So it will be taxable in the year 1920, that is assessment year 2021. So remember, the year when you're receiving even a part of that consideration, that particular year when you're receiving the compensation, it will be taxable in that year. The entire amount, students, not in part, the entire amount will be taxable in the year where you're receiving even if a part of a consideration. Indexation benefit will be available till the year of compulsory acquisition. So the year the government has compulsorily acquired, or the law has compulsorily acquired your capital asset, up to that year you will get the indexation benefit. So we will see a problem on this so that you all properly understand this particular provision. One more thing, students, suppose government is acquiring my house property compulsorily acquiring my house property. I have no option. They are compulsory going to acquire my house property for suppose 50 lakhs. So they are paying me a compensation of 50 lakhs. But I am not satisfied with 50 lakhs. I feel that my value of my house property should be 55 lakhs. So I ask for extra compensation to the government. So that is extra compensation is nothing but enhanced compensation. So I go to the court and I, file a case saying that I want an increase in the amount of compensation that has been given. So such type of compensation is called as enhanced compensation. When you're asking for more than the compensation that you're receiving, okay, it is called enhanced compensation. So suppose the government agrees, after several legal cases, the government agrees, okay, instead of 50 lakhs, we'll give you 4 lakhs. So that 4 lakhs becomes your increased compensation, which is called as enhanced compensation. So let us now see what is the treatment we have to do in case of enhanced compensation. So this treatment, what we have seen is for initial compensation. Initial compensation is the compensation that has been decided by the government, and enhanced compensation is when the SSC is not satisfied with the initial compensation, he will ask for extra compensation. That extra is called as the enhanced compensation. So let us see the treatment for enhanced compensation and then a problem on both. So tax treatment of enhanced compensation. Sale consideration, you have to take total enhanced compensation or consideration received. See students, enhanced compensation means only now in my example 50 lakhs and 54 lakhs. 4 lakhs only will be your enhanced compensation. So 4 lakhs will be your sale consideration. Now, such compensation shall be taxable in the year of receipt only. If a part installment received, then only part amount shall be taxable and not the entire amount. So enhanced compensation will be taxable only in that year where you are receiving the extra 4 lakh rupees. So you cannot tax it in the year when you're receiving the initial compensation. So remember students, enhanced compensation is taxable only in that year when you're receiving such extra compensation. And suppose out of 4 lakh, they are giving you 2 lakh in a particular year and 2 lakh in the next year. So accordingly, you have to, in part, you have to tax it in that particular year. Expenditure on transfer, it will be as usual, but litigation expenses for getting the enhanced compensation is also to be included in expenditure of transfer. Cost of acquisition and cost of improvement will be nil. So always remember students, this is very important. In case of enhanced compensation, cost of acquisition and cost of improvement is always going to be nil. Whereas in case of initial compensation, cost of acquisition, cost of improvement will be your normal thing. But in case of enhanced compensation, cost of acquisition, cost of improvement will always be nil. Taxable in the year when such enhanced compensation or consideration is received. Nature of gain on enhanced compensation, whether it is now, whether we should consider such enhanced compensation as short term or long term. So it depends in case of initial compensation or consideration. If the initial compensation is a long term, then take enhanced compensation also long term. If it is short term, you take it as short term. Indexation, there is no question of indexation because cost of acquisition and improvement, anyways you have to take it as nil. Interest on enhanced compensation, suppose because they are giving you enhanced compensation, extra compensation a little late, they may give you interest. So such interest on enhanced compensation will not be taxable under the head capital gains. It will be taxable under the head income from other sources. So is this clear what is initial compensation and what is enhanced compensation in case of compulsory acquisition, students? Students, have you understood the provision of initial compensation and enhanced compensation? Yes? Students, are you all there?
Yes, ma'am.
So let us see a problem on problem on where your asset is compulsorily acquired by law. So Sunil has a house property which is acquired on 7/7/1995 for 3 lakh. Now what is this? What is this particular term? Yes, students, what is this particular term?
Cost of acquisition, ma'am.
Okay. So is there only one student who's attending this lecture? Yes? Where are the others? Yes, students, are you all paying attention?
Yes, ma'am.
Yeah.
Yes, ma'am.
Why are you not replying? Why is there no interaction? He incurred improvement expenditure on such property worth rupees 70,000 on 16/8/2000. So tell me, what is this, students? He incurred improvement expenditure on such property of 70,000. What is this?
Cost of improvement, ma'am.
And 50,000 on 17/7/2010. Market value of such property as on 1/4/2001 is 4,50,000. So students, we have already seen in our earlier lectures that if any property is acquired before 2001, what is the cost of acquisition we are supposed to take? The cost of acquisition we are supposed to take is actual cost of acquisition, that is 3 lakh, or fair market value of the property as on 1/4/2001, whichever is higher. So your cost of acquisition will be what, students? Will it be 3 lakh or 4,50,000?
4,50,000, ma'am.
4 lakh
Very good. So
50,000,
keep in
ma'am.
mind, in this sum, the cost of acquisition is 4,50,000. Now, second, cost of improvement. Improvement is made before 2001. And we have already seen in our earlier lectures that if any cost of improvement is made, improvement expenditure is made before 2001, it has to be completely ignored. It has to not to be taken into account. So now, should this 70,000 be considered or not to be
No,
considered?
not to be considered.
It should not be
No,
considered
no,
because it
ma'am.
is incurred before 2001. So remember, any cost of improvement that is incurred before 2001 is to be completely ignored. Now, should we ignore this 50,000 cost of improvement or should we consider it?
We should consider it.
Very good. So we know that the cost of acquisition is 4,50,000. Cost of improvement is going to be only 50,000. Okay, so I hope you'll have understood up to here. Now next, on 16/8/2013, so in the year 2013, such property is compulsorily acquired by government. Okay, and the compensation decided is 11,50,000. So government is compulsorily acquiring Sunil's property and giving him a compensation of 11,50,000. Okay, 20% of the compensation was received on 31/3/2019. So out of this 11,50,000, the first part of the consideration is received on 31/3/2019. So students, tell me, in which assessment year it is going to be taxable? Now, if you're receiving the compensation on 31/3/2019, means you have received in the financial year 18-19. So it is going to be taxable in which year? Which assessment year?
2021. 2021.
The provisions that compensation is taxable in the year when you're receiving it, correct? Even if part you're receiving initial compensation, even if you're receiving in part, you're going to tax it in that year where you're receiving the first part. So this entire compensation is going to be taxable in that year where you're receiving the first part. So first part is received in 31/3/2019. Which financial year does it fall? 2018 April to March 2019. Means the assessment year will be 1920. Assessment year is immediately after the previous year, right? Financial year. So initial compensation will be taxable in the year 1920. Okay. and the balance out of 11,50,000, 20% he's got on this date, and balance he's got on 2/4/2019. So this falls in the next financial year, but we know that initial compensation is taxable in that year where you're receiving the first part of the compensation. So the entire 11,50,000 will be taxable in the assessment year 1920. Have you all understood this part? We have seen here that taxable in the year in which such compensation or part thereof is first received. So the entire compensation is taxable in that year where you're receiving the first part. The first part is received in the year 1819, that is assessment year 1920. So entire 11,50,000 will be taxable in the year 1920. Now, on further appeal, on 16/8/2019, enhanced compensation is declared by the government. That is 2 lakh. It is only declared by the government that he will be paying Sunil an enhanced compensation of 2 lakh. But enhanced compensation is taxable in which year, students? It is taxable in the year in which you're receiving the enhanced compensation and not when you're declaring. Correct? And the expenditure incurred to get the enhanced compensation is 11 lakh. So this becomes your expenditure on transfer or expenses on transfer. Such compensation, such enhanced compensation is received when 18/8/2020. So tell me, in which assessment year will this be taxable, students? Enhanced compensation you're receiving on 18/8/2020. So which assessment year should this enhanced compensation be taxable? Yes, students.
2020 and 2021, ma'am.
Which assessment year I'm asking? Correct. Financial year you have told correct that in 2020-2021 financial year it will be taxable. That is correct. Which assessment year it is to be taxable? 2021-2022. There's difference between assessment year and financial year, right? There's difference between. Yes. So when I'm asking assessment year means you have to tell 1 year ahead the previous year or 1 year ahead the financial year. So financial year you have told correct that 2020-2021 it will be taxable, but assessment year 2021-2022. Compute income from the head capital gains of Mr. Sunil for the assessment year 1920, 2021 and 2021-2022. So let us start, students. Computation of capital gains of Sunil for the assessment year. First we'll take 1920. Okay. Now 20% of the compensation is received on 31/3/2019. Means assessment year is 1920. Now sale consideration, we know in case of compulsory acquisition, it is compensation received. So how much is the compensation received? 11,50,000. So we are taking 11,50,000. Less expenses on transfer. In the case of initial compensation, no expenses on transfer is there. So it is nil. So we got 11,50,000. Less indexed cost of acquisition. Now, how do you calculate indexed cost of acquisition? First we have to see whether it is long term or short term. It was acquired in 1995, but the compensation was received in 2013. Sorry, the property was acquired compulsorily on 2013. So obviously it is a long term capital asset. So we are doing indexation. How do we do the indexed cost of acquisition? First you take the cost of acquisition, which we know is 4,50,000. Into, now indexation benefit in case of compulsory acquisition is available only up to the date of compulsory acquisition. So only up to 2013 you will get the indexation benefit, because as per the provisions, indexation benefit is available only till the year of compulsory acquisition and not till the year of you're receiving the compensation. So here it is compulsorily acquired in the year 2013. So what is the CII index of 2013? So 13-14, the CII index is 2020. 220. So 4,50,000 into 220 divided by the CII of the year of acquisition. Now, since it is acquired before 1995, we have to take 100 as the base because the CII is starting from 2001 and it starts from 100. So that is why we're taking 100. When you solve this, you will get 9,90,000. Next, cost of improvement, we know it is 50,000. 50,000 into, again, indexation benefit is available only up to the date year of compulsory acquisition. So 220 up divided by the year of cost of improvement. So what is the year of cost of improvement? 2010. So what is the CII of the year 2010? It is 1011, it is 167. So we divided by 167. So we got 65,868. Then total comes to 10,55,868. When you minus, you get long-term capital gain as 94,132. Let us see the notes. The initial compensation of 11,50,000 decided by the government shall be treated as a sale consideration. Cost of acquisition is the original cost of acquisition, that is 3 lakh, or fair market value as on 1/4/2001, whichever is higher. And cost of improvement before 2001 shall be completely ignored. Though the property was compulsorily acquired by the government in the year 13-14, but the compensation was received in the year 18-19. Therefore, the entire amount shall be taxable in the previous year 18-19. However, indexation shall be available only till the previous year 13-14. So all whatever I've explained, we have written it in notes. So students, have you all understood the computation for the assessment year 19-20? Did everyone understand the computation for the year 19-20? Why have we not considered enhanced compensation here? Because enhanced compensation is taxable only in that year when you're receiving the enhanced compensation. So still in the year 19-20, you have not received the enhanced compensation. Did everyone understand this? Yes?
Yes, ma'am.
Okay. Now let us go to the year 2021. They are telling also compute for the year 2021. Now 2021, is any computation required? Because enhanced compensation you're receiving in the assessment year 2021, 2022. So in 2020, 2021, they are only declaring the enhanced compensation, but you're not receiving it. So in the assessment year, computation of capital gain of Mr. Sunil for the assessment year 2020-2021. As the SSC has not received enhanced compensation during the previous year 2019-20, hence nothing is taxable in the assessment year 2020-2021. Okay. Next, they are telling also compute the income from the head capital gains under which assessment year? 2021-2022. Now tell me students, he is receiving the enhanced compensation in the financial year 2020-2021, means it will be taxable in the assessment year 2021-2022. So what is the enhanced compensation is receiving? 2 lakh rupees. Expenditure on that compensation is 11,000. And we know that in case of enhanced compensation, the cost of improvement and cost of acquisition is always going to be nil. So let us see. Computation of capital gains of Mr. Sunil for the assessment year 2021-2022. Sale consideration is nothing but the enhanced compensation of 2 lakh rupees. Less expenses on transfer, which is 11 lakh. So net sale consideration is 1,89,000. Index cost of improvement and index cost of acquisition is going to be nil, because as per the provisions, in case of enhanced compensation, always your cost of acquisition and cost of improvement is going to be nil. So your long-term capital gain is 1,89,000. Why have we taken it as a long-term capital gain? Because in case of enhanced compensation, you have to see initial compensation. If initial compensation is long-term capital gain, enhanced compensation also will be long-term capital gain. If initial compensation is short-term capital gain, enhanced compensation will also be short-term capital gain. So in case of enhanced compensation, the cost of acquisition shall be taken as nil and the nature of capital gain shall be the same as that of initial compensation. So we have completed a sum on compulsory acquisition where what is the treatment we have seen for initial compensation and what is the treatment we have seen for enhanced compensation. So students, have you understood this particular computation of capital gain on compulsory acquisition? So have you all understood, students? Yes, students?
Yes, ma'am.
Okay, so quickly I'll just ask you all some questions just to see whether you all have understood it or no. Tell me, students, that initial compensation is taxable in which year? Which year are you going to tax the initial compensation? The year that you're receiving the compensation or the year that where it is compulsorily acquired by the government? Which assessment year you will tax it? Which assessment year are you going to tax the initial compensation? Is it the assessment year in which you're receiving the compensation, or is it the assessment year in which the government is acquiring the property? Students?
Initial year, ma'am.
Correct. In the year in which the initial compensation is being received. Now, what is the meaning of enhanced compensation? What do you mean by enhanced compensation? And when is it taxable? Students?
Ma'am, when government has acquired.
Enhanced compensation means compensation over whatever the SSC is receiving over and above the initial compensation. Okay, extra compensation what he is going to receive above the initial compensation is called enhanced compensation. It will be taxable in the year when you're receiving that compensation, not when it is declared. It will be taxable in the year when you're receiving such enhanced compensation. And interest on enhanced compensation, under which head it will be taxable, students? Why are the other students not answering? Why are not paying attention? Yes, students? Can everyone hear me? Am I audible to everyone?
Yes, ma'am, you are audible.
Then why are you not replying? Did you all understand this concept of initial and enhanced compensation? Yes? Students, I'm talking to you all, right?
Yes, ma'am.
Yeah. So tell me, interest on enhanced compensation if you're receiving, under which head it will be taxable?
Income from other sources.
Correct. Then why all took so much time in replying? Okay. Next, let us see deductions. Okay. We know that how to compute capital gain. This is the format for that. Sales consideration, less expenses on transfer, we get net sale consideration. Less cost of acquisition, cost of improvement, we get short-term capital gains. Up to here, we have seen the sums, we know how to compute. After that, there is something called as exemptions. So from the short-term capital gain, when you give certain exemptions, you get taxable short-term capital gain. This taxable short-term capital gain is chargeable to tax. Exemptions are nothing but deductions. Now, what all deductions are available and under which all sections we will be seeing today. Similarly, for the calculation of long-term capital gain, we know that the format is sales consideration less expenses on transfer. You get net sales consideration. From that, if you minus index cost of acquisition, index cost of improvement, you get long-term capital gain, which we have already seen up to here, several sums and problems. Then when you deduct the deductions from the long-term capital gain, you get taxable long-term capital gain on which you are supposed to charge tax. So today and now we will be seeing the exemptions, which is also called as deductions from short-term capital gain as well as long-term capital gain. So these are the different deductions available, students, okay, which you will get from your capital gains that is arising either short term or long term. So deductions are under section 54. This deduction will be available on capital gain if there is a sale of residential house property. So if you're selling a residential house property and if you're getting a capital gain, you will get a deduction under section 54. Under section 54B, it is capital gain on transfer of agricultural land. Under 54D, it is capital gain on compulsory acquisition of land or building forming part of industrial undertaking. 54EC, capital gain on acquisition of certain bonds. 54EE, long-term capital gain invested in notified funds. 54F, long-term capital gain invested in residential house. 54G, capital gain on transfer of asset in case of shifting of industrial undertaking. 54GA, capital gain on transfer of asset in case of shifting of industrial undertaking from urban area to any SEZ, that is special economic zone. 54GB, long-term capital gain on residential property subscribed in equity shares. So students, important is from section 54 to 54F, whereas 54G to 54GB also I will be explaining, but it doesn't carry that much importance from exam perspective. So from section 54 to 54F, in detail we will be seeing that when is this deduction available, to whom it is available, and what are the conditions that is required to make sure that this deduction is available. So let us go one by one, seeing in detail analysis of these particular deductions. So let us first see deduction under section 54. So first of all, who is eligible for this deduction? So the eligible SSC is only individual and HUF. So only if an SSC is falling under the category of individual or Hindu undivided family, then only he will be eligible for getting a deduction under section 54. Now, on what asset that he is transferring, he will get this deduction. Remember students, asset transferred by this particular SSC should be only a residential house, and that too it should be a long-term capital asset. So that means if an individual is transferring a short-term capital asset which is a residential house, he will not qualify for deduction under section 54. So first thing is, it is eligible only for individual and HUF. The asset that he is transferring should be a residential house, and he should have a long-term capital gain from that residential house, and that house should be chargeable under the head income from house property. Now, when he will get the deduction? He will get the deduction only if he is investing that gain amount in one more residential house situated in India. So remember students, he's transferring one residential house. Whatever gain he's getting from that residential house, he should invest in one more residential house situated in India. So what is the time limit for the investment or construction? If he's purchasing the house, new house, he should purchase within 1 year before or 2 years after the date of transfer. Or if he's constructing the residential house, he should construct within 3 years after the date of transfer. So this time limit he should construct or purchase. If he's exceeding the time limit for construction or purchase, this deduction will not be available to him. So all these are the terms and conditions which if he fulfills, then only he will be eligible for deduction under section 54. Now, what is the amount of deduction he will get, or what is the amount of exemption he will get is cost of new residential house. What is the cost? whatever is the cost of new residential house or capital gain, whichever is lower is exempt. So remember students, just remember, deduction under section 54 is available only to an individual or HUF who is getting a long-term capital gain on a residential house and investing that capital gain in another residential house. I'm telling residential house only investment should be made in India. The new residential house should be purchased within 1 year or before, either 1 year before the transfer or 2 years after the transfer, or construction of the house should be completed within 3 years from the date of transfer. If he fulfills all these conditions, then he will be eligible for deduction under section 54. So students, have you understood this deduction, to whom it is available, when it is available, where he should invest the capital gains? Did everyone understand this section 54? Yes, students?
Yes.
Okay. Next, deduction under section 54B. Who is going to get this deduction? Eligible SSC is an individual or HUF. What asset he should transfer to get this deduction? He should transfer the urban agricultural land. Now, why it is not rural agricultural land? Because obviously rural agricultural land is not a capital asset. So even if he's transferring, there is no capital gain arising, correct? So asset what he is transferring should be an urban agricultural land. Either it can be short term or long term. Other condition is land should be used for agricultural purpose only by the SSC or by his parents or HUF for 2 years immediately preceding the date of transfer. The qualifying asset, that is asset in which the capital gain has to be invested, is again he should invest in a land which is used for agricultural purpose. It can be urban or rural. Time limit is he should purchase that land within 2 years from the date of transfer. Exemption is cost of new agricultural land or capital gain, whichever is lower is exempt. So remember students, section 54 we saw, he is transferring residential house, investing the capital gain in a residential house. Section 54B, he is transferring a urban agricultural land and investment he is making in another agricultural land, which can be urban or rural, but he should purchase it within a period of 2 years. Then only he will get a deduction under section 54B. So students, have you all understood this deduction under section 54B? It is available only if the SSC is transferring urban agricultural land and investing in a agricultural land which is either urban or rural, but he should invest it within a period of 2 years. So did you all understand section 54B? Deduction under section 54B. Is this clear?
Yes, ma'am.
Okay. Next section, deduction under section 54D. D says, D under section D, eligible SSC is any SSC. Till now we saw section 54, 54B, where we saw that deduction was available only to individual and HUF. But 54D is available to any SSC. Let it be company, partnership firm, LLP. It is available to any SSC. What is the asset that is to be transferred to get this deduction? It should be a land or building forming part of an industrial undertaking, not residential undertaking. It should be an industrial undertaking. So if any SSC transfers any land or building which is a part of an industrial undertaking, he will get this deduction. Let us see what is the other conditions. The land or building have been used for the business of undertaking for at least 2 years immediately before the date of transfer. So today when you're transferring the land and building for industrial undertaking, you should have used that land or building at least for a period of 2 years before transferring for the purpose of your business. The transfer should be by the way of compulsory acquisition of the industrial undertaking under any law. So this deduction under section 54D you will get only when your land or building is compulsorily acquired under any law. Then only you will get this deduction under section 54D. Next, whatever gain you're getting on this compulsory acquisition, you have to invest in qualifying asset in which capital gains has to be invested. So you have to invest that capital gain in again a land or building or right in the land or building. So the investment should again be made in a land or building. What is the time limit for purchase or construction? Purchase or construct within 3 years after transfer. So within 3 years after transfer, you have to either purchase the land or building. Next, what is the amount of acquisition, exemption, cost of new asset or capital gain, whichever is lower. So remember students, section 54D available to any SSC where that SSC should transfer or sell his land or building which is forming part of industrial undertaking. It should be compulsorily acquired under any law, and the capital gain should again be invested in a industrial undertaking, that is a land or building. Okay, and within 3 years he has to make sure that he is purchasing or constructing that land or building. Then only he will get this particular deduction under section 54D. So students, have you all understood this deduction under section 54D? Yes?
Yes, ma'am.
Okay, next. Deduction under section 54 EC. Who is eligible to get this deduction? Any SSC. Under EC, any SSC. Remember, section 54 only individual HUF, section 54B individual HUF, section 54D we have seen any SSC. Even under section 54 EC, any SSC is eligible for getting this deduction. What asset he should transfer to get this deduction? He should transfer land or building or both, but it should be a long-term capital asset, means only a long-term capital gain if he's getting, then only he will be eligible for deduction under section 54 EC. Now that gain what he's getting, where should he invest in order to get the deduction under section 54 EC? He should invest it in the bonds of NHAI, that is National Highway Authority of India, or RECL, that is Rural Electrification Corporation Limited, Company Limited, or any other bond that is notified by central government. So remember, he should invest such long-term capital gain in the bonds of NHAI or RECL or any other bond that is notified by the central government. Now, by what time he should invest in that bonds? He should invest within 6 months from the date of transfer. So within 6 months from the date of transfer, he should invest the capital gain, long-term capital gain into these bonds. And these bonds should be redeemable only after 5 years. Means you can remove money from these bonds only after a period of 5 years. What is the amount of exemption? Capital gain or amount invested in specified bonds, whichever is lower. Maximum permissible investment out of capital gain arising in any financial year is 50 lakhs. Whether such investment is made in current financial year or subsequent financial year or both. So remember students, capital gains or amount invested, whichever is lower, you will get as an amount of deduction, and maximum is up to 50 lakhs. So is this clear students? Section 54 EC, is this clear? Yes students? So here the SSC should be transferring a land or building, but it should be a long-term capital asset. So obviously you'll get a long-term capital gain. That long-term capital gain should be invested in the bonds of NHAI or RECL, Rural Electrification Corporation Limited, or any other bond that has been specified by the central government. Should be redeemable only after 5 years. You should purchase that bonds within 6 months from the date of transfer. So is this particular deduction clear students?
Yes, ma'am.
Next, you will understand it better when we solve problems on like considering deductions. So how to identify which section and all, we will see in the subsequent lecture. Now let us see deduction under section 54 EE. Remember students, under section 54 EE, this deduction is available to all the SSC, that is any SSC. Asset transfer should be a long-term capital asset, any long-term capital asset. Okay, it is not land or building or industrial undertaking or urban land or residential property. It can be any long-term capital asset. Okay, and that long-term capital gain should be invested in units issued before the 1st April 2019 of specified fund as notified by the central government. If it is invested in this particular units that is notified by the central government, and that subscription to the units is made within 6 months from the date of transfer. And similarly, the amount of deduction will be the capital gains or the amount invested in notified units of specified fund, whichever is lower, maximum 50 lakhs. So section 54EE also is not that important from the exam point of view, but all you need to know is who is eligible for the deduction, what asset should be transferred, the gain from the transfer, where it should be invested, and that investment by what time limit it should be made in order to get this particular deduction. So have you understood section 54EE? Yes, students?
Yes, ma'am.
Next, 54F. This deduction is available to only an individual or HUF. It is not available to everyone. This deduction is available to only an individual or HUF. Asset that has to be transferred should be any long-term capital asset, but it should not be a residential house. So asset transfer should be any long-term capital asset other than residential house. Other condition is SSC should not own more than one residential house on the date of transfer. He should not purchase within 2 years or construct within 3 years after the date of transfer another residential house. This condition should be fulfilled. Next, whatever gain he is getting, he should invest in one residential house situated in India. Students, individual or HF, he should transfer a long-term capital asset which is not a residential house, but he should invest it in one residential house situated in India. Then only he will get deduction under section 54F. Now he should invest in a residential house. Now that residential house should be purchased within 1 year before or 2 years after the date of transfer, or should construct it within 3 years after the date of transfer. What is the amount of exemption he will get? Cost of new residential house. If it is more than the net sale consideration, then the entire capital gain is exempt. If the cost of new residential house is less than the net sale consideration, proportionate capital gain is exempt. So section 54F we will be seeing in the problems as well, so that you'll understand better the amount of deduction. So students, remember section 54F is available only to individual and HUF who is transferring any long-term capital asset which is not a residential house, but he is investing in a residential house. That residential house should be purchased 1 year before or 2 years after the date of transfer, or if he is constructing it, he should construct it within a period of 3 years. Then only he will be eligible for deduction under section 54F. So students, have you understood this deduction under section 54F? Yes? Yes, students?
Yes, ma'am.
Okay. So by this we have seen different deductions under section 54, 54F, 54B, 54D, EC, EE and F. So summary, a short summary I have written of all the deductions together: 54, 54B, D, EC, EE, F. Like who is eligible SSC, what asset he is supposed to transfer, what are the other conditions he should fulfill, what is the qualifying asset, that is the long-term or short-term capital asset, in what he should actually invest to get the deduction, what is the time limit for purchase or construction, what is the amount of deduction he's supposed to get. So why I have not covered sections like 54G, GA and 54GB, the reason is because that is not that very important from exam point of view, but I will just tell you that section 54G is nothing but when you are transferring your capital gain, whatever is arising on transfer of asset, in case of shifting of industrial undertaking from an urban area, when you're shifting and you're getting any capital gains, you will get a deduction. Next, 54GA is exemption or deduction of capital gain on transfer of asset in case of shifting of industrial undertaking from urban area to special economic zone. And 54GB is exemption of long-term capital gain on transfer of residential property. So 54G, GA and GB are not that very important, but I will be also giving that particular conditions in your notes. So I hope you'll have understood the deductions from section 54 to 54F. In my next lecture, we will be seeing problems where deductions will be applicable and where we are going to solve those particular problems considering these all conditions and amount of exemptions. Thank you so much, students.